One of the surprising things about 2019 was, despite the political risk, the political uncertainty, the trade war, Brexit, equity markets were still pretty firm. So I think one of the biggest risks for members is actually not being in the markets and for pension funds to cut their weighting in stock markets too early. So we, rather than cut weighting significantly, we are managing our risk for members in different ways. So when we think about risk management, we are looking to diversify predominantly, so we're in a range of different asset classes, and we're also looking for investment opportunities which maybe are a bit less volatile. So our move into private markets would be a good example of that. When we're lending to real estate companies or to infrastructure projects, we've got stable cash flow, we've got security against assets, and therefore the risk will be significantly reduced compared to just being in the stock market, for example. So the 2040 retirement date fund returned just under 17% over the year. The fund choices also performed strongly. So we've got good exposure to equities, but we also have those corporate bonds, property, commodities. So we anticipate reasonably firm markets in 2020, not as good as 2019. So in 2019, for example, the S&P 500 was up nearly 30%, but we expect firm markets. But we are concerned about climate change, and we're beginning to see the impact of climate change across the world. Fires in the Amazon basin, the bushfires in Australia, for example. Therefore, we need to increase the ESG risk management, and particularly the climate change management in our portfolios, and that's going to be a real focus for us over this year and the coming years.